Good morning. Welcome to the Forex Pro Charts weekly analysis for the week of October the 17th, 2010. As you know, we provide our subscribers with a full analysis every week of 10 major currency pairs, and then we select one pair every week and post that as a free analysis in a video format. This week we're going to be looking at the Euro USD pair, which I know is a very popular pair for many of you. We start out by looking at the monthly time period chart, and what we're looking for here is to see where price is currently falling within our trading field. The trading field is delineated by the monthly highs and lows as marked by these solid black lines, and then we're looking also at the monthly and the weekly armpits as outlined by the thick dotted lines, the monthly and then the weekly, and we have those at both the resistance and the support levels. So here's our monthly and weekly armpits at the support level. We can see here that price is moving, had come down within this monthly armpit here and had reversed and is now moving back up, and looks like it will be moving back up towards the edge of our playing field and is approaching but not really very close to the monthly armpit. That means that we still have plenty of room for day traders and swing traders to take trades in either direction. However, we do, for swing traders especially, like to look at the overall trend of the currency pair, and we can see that here the Euro USD is in an overall uptrend, although it has flattened out fairly recently, which is the result of this kind of ranging action that we've seen over the last period of time. And you can see there that the 50 EMA is kind of flattened up but still is in an uptrend. So for swing traders, buys would still be our preferred trend direction until we get up very close to the outer edge of our playing field, at which point we could be expecting to see price reverse long term. And of course the 50 EMA is a lagging indicator and will not show a downtrend until well after price has reversed and started down. As you can see here, price reversed, the 50 EMA would still have been showing up, but we would have been preferring sells at this point because price was in an overall very strong downtrend. And you can see that we have a large gap here where we don't have any zones, and that's a function of how strongly price has been moving over the last couple of months, that we don't see a lot of zones that have formed here. Instead, we see our zones at the outer extremes of the playing field. So let's take a look at the weekly chart. And we can see here that price is right at a resistance zone, and I think as we go further along we'll see that actually price has already hit the armpits in these zones, and we'll be looking to see which direction price will take. For our day traders, this zone presented a nice opportunity for a bounce off the 60-minute armpit, and we'll be looking to see whether price reverses, which it kind of looks like it's doing. We see a doji right here, which is a traditional indicator for a potential reversal in traditional technical analysis. That, combined with the fact that price has hit our zone here, would indicate to us that we may see at least a retracement, possibly down to this support zone, but if not, at least some kind of retracement and then back up to possibly to this zone. We don't really, except for the daily trend lines, we don't see any other extended trend walls that would be impacting our trading this week. They are up above in this zone here and then further down. Now we do like to look at the overall chart patterns on the weekly time period, and what we see here is that the current zone that price is at was part of an overall downtrend on the weekly chart and did not have the rally base drop pattern that we like to see, and we see a clear example of this pattern here up at the upper edge of our trading field where price rallied. We built a base as it consolidated, and then price dropped. We also see a smaller pattern, but still a rally base and then drop at this zone right below the monthly armpit. So for swing traders who are looking for some kind of reversal, again, swing traders would probably want to be taking a buy, but more aggressive swing traders who are looking for a place to take a sell would not want to trade off of this zone. Even though we do see the doji, they would be more likely to want to trade off of this zone where we see the rally base drop pattern combined with the monthly armpit, where we should, if we don't see a complete reversal down, we may see some kind of retracement and bounce, particularly if the extended trend wall is still running through, depending on how quickly price would move there. However, like I said, we would be anticipating that we would be seeing some kind of price reversal because of this doji on the weekly here, and price may not get to this point this week. Let's go ahead and take a look at the daily time period. And we can see that price moved up. We don't see and did not form any zones. It's just moved steadily up since it left this support zone a couple of weeks ago. Moved right on up, and you can see where price hit the daily and then the 60-minute armpit, and you can see that then price did reverse when it hit the 60-minute armpit, which of course is where our day traders are looking to take their bread and butter trade, is right off of that 60-minute armpit. We're looking for the bounce that occurs very, very consistently off that 60-minute armpit, and we're looking to take a trade and capture some pips there. We can see that the daily trend walls, just because price has been moving so steadily, just following price right up, and again we're looking and we see this extended monthly trend wall, but not anywhere near this zone. Instead, it is intersecting this next zone here. So we see that price hit this zone, moved up to the 60-minute armpit, and now has retraced back down. Now, if you notice, this zone was right around the 1.4100 mark, and that is a strong psychological barrier when we have price ending in a 00 or a 50. And so we see that that price did bounce off of that and move back down. In fact, it moved below the 1400. Actually, 1400 is generally an extremely strong psychological barrier. Price spiked up. If you look at it again on the weekly, you see that price spiked up above the 1400 price point, and then retraced back down and closed below. This would be another reason, in addition to the doji, that we would be thinking that price may go ahead and have a longer term retracement here before taking a direction one way or the other. So again, back to the daily, we see where price moved up into the zone, hit the daily armpit, hit the 60-minute armpit, bounced back down, actually had a very nice bounce for over 150 pips, it looks like. And let's examine that price action a little bit more closely on the hourly chart. So if we look at the hourly chart, we will see that when price looked like it was hitting the daily armpit with this candle right here, it actually did not quite reach the daily armpit, and I don't believe that it hit our 5 pip cushion that we generally recommend placing for an entry trade. So we saw a little bit of a bounce in this area, but price had not directly hit the armpit. Price moved back down, but then moved back up, and right here is where we saw price hit the 60-minute armpit, and actually came within a pip or two, but again with that 5 pip cushion, we see that price hit that armpit and bounced way back down again for actually close to 200 pips. Now, depending on your trading plan, would depend on exactly how many pips you were able to capture. And let's just review that trading plan again very briefly. The trading plan, the Forex Pro Charts signature trading plan, is that you take a 3-part trade entry on the 60-minute armpit, and you can set that up as an entry trade when you realize that price is approaching these approaching the zone and approaching the 60-minute armpit, we recommend that you set up an entry trade in 3 parts. The first part you set up, on all of the parts you set your limit 10 pips above the end of the zone. If you see a left behind target right above the zone, you may want to extend your stop out a little bit, but generally we recommend placing a stop 10 pips beyond the end of the zone. Place your entry 5 pips before the 60-minute armpit. That means that you won't miss these trades where price comes within a pip or two of reaching the armpit and then has its reversal. Then you set that up in three portions. The first portion, all you're looking for is about 20 pips. And you set a limit for there. When that first portion hits the 20 pips, that trade closes out, and on the remaining 2 portions you move your stop to break even. Then those remaining 2 portions are basically free trades, and there's a little bit more variation in how traders work those two. What we recommend is that on the second portion you have a longer limit, somewhere between 50 and 100 pips depending on your personal preference, so that your second portion then would close out when it reached that second limit of, say, 100 pips. So then you would have captured 20 pips on the first portion of the trade, 100 pips on the second portion of the trade. Then the third portion of the trade, you leave your stop at break even, and you have a choice of how to handle that. You can either set your limit for the ultimate target, which generally is the zone, in this case the resistance zone, the support zone below this resistance zone would be your ultimate target. You can either leave your stop at break even and wait for price to move to that ultimate target, because as we've seen, we very often have large retracements in the course of that, and if you keep your stop too close, it will stop you out before you hit your ultimate target. However, if you prefer to at least capture some pips on that trade, you can go ahead and continue to move your stop down as price continues down. So that what would happen then here on this, if you had your third portion of your trade still open, you could be moving your stop down, say, every 50 pips or every 75 pips, no closer than 50 pips, again because of the likelihood of retracement, and it looks like we may see a retracement here. Then depending on how you have that stop set up, you may capture the entire movement of price, and that's just a nice little bonus trade. It may stop you out if it does not go all the way to your limit and you're leaving your stop at break even, but again, it was a free trade. So the third portion of the trade is where you have the opportunity to really capture a trend as it forms, which it generally forms out of these supply and demand zones. You have the opportunity to capture those pips on that third trade, but if you don't, again, no worries, because you've had nice pips on the first portion of your trade, very, very consistently on the second portion of the trade, a good percentage of the time, and those are your bread and butter trades, and that's your signature trade setup. For more information or to subscribe to our full analysis and charting services, please go to www.forexprocharts.com, and we look forward to seeing you next week for our weekly analysis. Good luck trading.